Did you know that 74% of Americans have financial regret? How much should I be saving? How much money should I have in the bank by this age? How much should I invest so that I can retire comfortably? These are top of mind questions for every professional that I talk to. And in today's video, I will share answers to some of these questions. These insights that I share today are based on my research, my personal experience, and deep and long conversations with my financial advisor. Before I get started, a quick reminder to 85% of you who haven't yet subscribed to my channel to do so now and click on the notification bell icon so that you can be notified every time I release a new video. There's a lot of energy and effort that I spend every week to create this content for you, and your support means the world to me. Your subscription helps with channel growth. It lets me know that you find value in the content that I build for you and inspires me to keep producing these powerful videos for you. And now that we have you subscribed, let's get started. Actually, a quick note before I get started. I'm not a financial advisor and this video is for education purposes only. The aim of sharing this video and the knowledge in this video is to get you started thinking on some of the aspects of financial freedom so that you can take the conversation forward with your financial advisor. While I started saving money when I started my first job, I really didn't start investing till 2015. So I have made mistakes in terms of not leveraging the compounding growth. I'll talk about some of those mistakes in these videos and what I should have done differently. It's a long video with a lot of information and valuable content, so make sure to watch the complete video and take notes as we go. And since the audience on my channel is from a wide age group, anywhere from 18 years to about 60 plus years, we'll cover that whole span. Let's get started with teens. Because many of the folks in the US and now even in India start making some money in their teens, or as parents, we have an option to invest in our children's future. In your teens, you have an opportunity to build your financial foundation. It's interesting that our schools do not have courses that teach about financial planning, and I think it's a big miss. So in this video, I'm going to cover some aspects of it. This stage is the biggest opportunity to create an abundance mindset and start building your beliefs around money. I missed out on that opportunity in my teens and grew up with a scarcity mindset around money. So if you are in the teens, or if you have kids who are teenagers, here's my advice. You probably have summer jobs that pay you $15 to $20 an hour. Most of us think about this money as great pocket money or candy money or the money that we can use to buy our wants. However, this is the perfect time for parents to open an investment account for the children and encourage them to put a nominal amount, even like $10 a week, during the time when the children are earning in summer months or other times of the year. At this stage, it's less about how much money they are putting in the account and more about learning the concept of investment and compounding growth. It's also about building a mindset where money is an enabler and helps you build a life where you are not stressed out about money because it's growing in your investment accounts. For example, I opened an investment account for my children last year with the gift money they got on their birthdays and the elementary school graduation. I invested in an SP 500 like fund, which has an average annual return rate of about 12% over last 10 years. There are various options that are available with investment companies like Fidelity to open these accounts. If you're already working with a company and contributing towards 401k, you probably have a Fidelity or a Morgan Stanley or any kind of investment account that's there. You can easily create those investment accounts for your children in the same parent account. You can do it in minutes for free and can self-manage these accounts. There are various calculators that are available online that can help you calculate how much returns you will get after 5 years, 10 years, 15 years, or 20 years. If you are a parent who is watching this video, make sure to do this exercise with your children. Allow your children to play with the calculator with different recurring monthly investments. When they input the monthly investment and see how their money is going to grow, they become aware of the power that they have in designing their financial future. The goals at this stage should be to become aware of the power of compounding, get in the habit of investing however small it might be, and working with various calculators and tools to monitor the progress of your accounts. Now, Let's move on to 20s. This is probably when you have just started working. You're likely earning an entry level salary, which is anywhere between $35,000 to $50,000 in the US. If you're in non tech fields, if you're in technology fields, you might be around anywhere between 75 to 100K at this stage. Many of you might have student loans at this stage. It's also a time when for the first time you're taking responsibility of all your expenses, including your health insurance. Many of you are also for the first time experiencing a regular monthly paycheck coming in, which is anywhere between $2,500 to $3,000. As tempting as it might be at this stage to use this paycheck to fulfill all your wishes, the wishes that you were not able to fulfill when you were getting an allowance from your parents, this is the time to build solid financial habits. Create a budget. This budget should include a fund for your wish list while focusing on paying off the debt and building on reserves. Given the current job market, I would highly recommend that you have 1 to 2 months of living expenses in a readily available bank account. Once you have this reserve built, you can then focus on investments. This is also the time to find resources and ways to build your financial and professional skill set. You'll be surprised how many courses are available for free to upskill yourself. I have a whole video on that. You can go check out my YouTube channel for this. If you are unable to find a course for free, but think that taking that course would really help with your professional growth, go ahead and use your discretionary budget money to join the course. Two things that I want to address over here. First is to focus on building assets rather than liabilities at this stage. So rather than spending money on buying a fancy brand new car with a higher monthly payment, try getting a good quality pre-owned car for a lower payment and use the remaining money to invest or to upskill yourself or to pay off your student loans. When I was in my 20s, I paid premium to buy a new car. It was a lot of money for me at that time. But within 6 months of buying the car, I got an opportunity to move to the US, which meant that I could no longer use that car. The value of the car had significantly decreased because it was now 6 months old. It was no longer a brand new car. And I was stuck with paying high monthly payments. In the hindsight, I could have used that money very differently. The second thing that I want to talk about here is not to forego long-term investing because you're tight on money. This comes from a personal experience. Wants expand to consume money that's not invested. When I didn't have the budgeting template in place, the months when I was left with just $100 or $150, my tendency was to go and spend it on eating out rather than investing the money. So if you have PPF, if you are in India, or 401k or Roth IRA options, if you are in the US, make sure to leverage that. Most companies contribute a certain percentage of your PPF or 401k. That's practically free money, so maximize on it. Time is on your side at this stage, and even small investments can grow significantly due to compounding. And your goal should be to leverage that. So, going back to my example, once I created the template and started using it, money was put aside for investing the moment I got my paycheck. This discipline helped me to save money that I needed for the down payment of my house. So in your 20s, focus on budgeting discipline. Very, very important. Building a reserve of 1 to 2 months of living experiences every year in your 20s. So when you're 21, put aside 1 month. When you're 22, put aside another 1 month. And that way, you build up the reserve over a period of time. And then the third goal should be to not incur credit card debt or any more liabilities. The habits that you build in your 20s will benefit you in the decades to come. If you want to know about how to manage your money on payday, I will link my Managing Money on Payday video in the comments. I also have a free budgeting template that you can download to budget your money. I'll add links to that budgeting template in the notes also. By the end of your 20s, you should aim at having a 401k or a PPF account in which you contribute every month about 10 to 12 months of living expenses, assuming that every year you save at least 1 month of living expenses. And this should be in a high interest yielding, easily accessible account and probably some kind of investment account for compounding growth. Please know that these are just guidelines. If you're not there yet, it's perfectly okay. Start where you are and move from there. 30s is the time when you start seeing the benefits of the investments you made in your teens and in your 20s. You'll have accumulated about 10 to 12 months of living expenses in probably a high interest yielding, easily accessible account. You would have also invested in your skills, so you probably have a few promotions under your belt or a few pay increases since you first started working. So in your 30s, you're probably changing jobs, getting married, having children, buying a house, building memories. This is the time when you use your financial base to grow exponentially. The basics remain the same. Keep an eye on how much you're spending on your liabilities. Don't rake up bad debt and continue to invest. This is also the time to increase the amount that you invest. In your 30s, you should be looking at investing close to 10 to 20% of your monthly income, maximizing on your 401k and taking advantage of ESPP or employee stock program if your company offers it. Just to give you an example, if you start from zero when you turn 30 and invest $500 every month in a high index fund like SP 500, by the time you're 40, you will have $102,000 in your account. If you have resources and start early, say at 25, you will have over $200,000 when you turn 50. That's the power of compounding, and you want to make sure that you make the most of it in your 30s. Your 30s are also the time to review your taxes to ensure that you are taking benefits of all the deductions. So, in your 30s, focus on maximizing your savings by investing about 10 to 20% of your salary, reviewing your portfolio to ensure that you're investing correctly and maximizing on tax deductions, and putting money aside for children's college fund or to fast track your mortgage payments. Your 40s are the time to start planning for retirement, and you don't need a financial advisor to get started. Most investment companies like Fidelity, Vanguard, and Charles Schwab provide free tools to plan for retirement. So if you haven't used these tools yet, make sure to leverage them. These tools analyze where you are on your investments and your projected expenses to give you a fairly good idea on how you're tracking towards your retirement goal. These tools account for inflation and are a good guideline for initial planning. Start putting your expenses in the tool. This is where your budget sheets would come in handy, and get an idea about how you are tracking towards your goal. Just to give you an example, I have a budget sheet that I created in 2008, and that budget sheet has tabs for every month up until now, and it continues to build up. So I have records of how I was spending money starting August of 2008. So if I can do it, you can do it too. It's a very simple budget sheet. I don't overcomplicate it, but it gives me a fairly good idea of inflation, of how I have been managing my money, and also how my expenses are changing, and the categories, as well as how much I'm spending based on my family's needs. Now, coming back to the tool, once you know the gap, you'll be able to work on a plan to fill it. Many people at this time also start building multiple sources of income as a plan for retirement. According to Fidelity, by age 40, you should have about 3 times of your yearly salary saved up. This means that if you're earning $75,000 a year, your retirement account balance should be around $225,000 when you turn 40. Your 40s are also the time to look at your family history and determine if and when you want to account for long-term care. If your family has history of Alzheimer's or other degenerative diseases, I would highly recommend that you plan for long-term care. If you have rental properties, account for monthly upkeep, property taxes, and insurance in your retirement expenses. Also, keep in mind that when you draw from your investments, you will have to pay taxes on capital gains during retirement. If the gap between your assets and your expenses is substantial, you might want to consult with a financial advisor to build strategies to bridge the gap. The goal in your 40s should be to maximize on your retirement contribution and adjust investments as needed. Plan for your retirement, including medical expenses and dependent care, and explore multiple sources of income. In your 50s, you start shifting towards more stable investments as you near your retirement. According to Fidelity, as you enter in your 50s, aim to have 6 times your annual salary saved in various accounts. For those in US, now is the time to double down on your 401k deductions because you are now eligible for catch-up contributions, allowing you to contribute more towards your retirement savings and potentially reducing taxable income. This is a very important step to ensure more secure financial future as you approach your retirement. This is also the time to review your social security benefits and evaluate various health insurance options so that you know what are your options when you retire. The goal at this stage should be to evaluate your investment portfolio and assess the best age to retire. Now let's talk about your 60s. According to Fidelity, by age 60, your goal should be to have saved 8 times your annual salary. This is the time to build out an yearly monthly draw plan so that you can strategically manage your withdrawals, ensuring that your savings last throughout the retirement and that you maintain a desired lifestyle. Adjust your withdrawals such that you have minimal tax withdrawal implications and you don't outlive your savings. Review your expenses carefully to address any expenses that you might not have accounted for while you are in your 40s and 50s and adjust your portfolio accordingly. Remember that whatever I shared with you today in this video, these numbers are just guidelines. Most of us are not there where we need to be in terms of our financial goals. Either we start late or things happen in life that derail us. While everyone's situation is unique, the goal is to start early, stay consistent, and adjust your portfolio as you go. If you found this video useful, I would love for you to subscribe. Over 85% of the people who watch my channel have not subscribed yet, and your subscribing would mean the world to me. Thank you so much for watching. Have a successful week. Bye-bye.